In November of 2017, the Tax Cuts and Jobs Act passed through Congress. This act amended the Internal Revenue Code and provided several changes to both businesses and individuals. Getting insight on just what those changes are and how they affect the average person has proven to be tough in the current political climate. There are some significant impacts on elements that have been part of the tax code for decades, like the marriage penalty, charitable giving, mortgage deductions, and college savings plans.
Hi, I'm Mary Owens with Owens Estate and Wealth Strategies Group. Welcome to our presentation on the Tax Cuts and the Jobs Act passed in December of 2017. Now, there are a few things about this tax bill we want to make sure we bring to your attention. First, the tax changes, the predominance of the tax changes, start as of January 1st, 2018. So they won't affect your personal income tax returns for most individuals and employers who file their 2017 tax return. Now, the other thing that's really important to note is most of the personal income tax changes that we're about to discuss completely expire at the end of 2025, and they'll generally revert back to the rules that exist in 2017. So yes, we're going to talk about all these changes, but we also want you to realize with all tax law, everything is subject to change at any time. Now, the first thing we want to talk about is the income tax rates. We had in the past, and we still have today, 7 different tax brackets. However, they've been modified to reflect different rates and different thresholds. So we have on the screen there both 2017 and 2018. And you will note, generally, all the rates went down except the very base rate of 10%. Now, the next thing we need to look at is how the rates changed for individual filers versus joint couples. In 2017 versus 2018, we've had some changes, and all of the brackets actually decrease the liability with the exception of one. Now, if you're a single individual, however, your tax rate will actually go up in one bracket once you exceed $400,000 and some odd of taxable income. But once you start to exceed over $500,000, it'll actually go back down. Now, the reason for these changes is they're trying to make single tax rates and joint tax rates more uniform. We have something in the past that's known as the marriage penalty, and it's been dissuading people from getting married. So let's go take a look at the married filing joint rates. It has generally the same impacts as the individual. All the rates are actually, and tax brackets are going down, with the exception in this case when you have, again, over $400,000 approximately of income. Now, once you exceed over $600,000, however, your rates still go back down. Now, why are they making one rate go up and the others go down? They're trying to create something as a uniform table so that individuals and married couples, even though they have similar income or disproportional incomes, don't actually get a tax increase when they get married. That has been a real sore point in the past. So let's talk about that just a little bit more. Many couples face the fear of having a larger tax liability as a couple than when they were single. This fear, this enormous fear, is known as the marriage penalty, and it really runs off a lot of people from getting married. A couple can incur a marriage penalty if the two pay more income tax filing jointly than they did if they would have filed as two separate individuals, and hence the marriage penalty. So when a couple gets married, their income is combined together on a new tax return. And if the couple by chance, one earns 90 and the other earns about 90, the marriage penalty that results is large. It's over $300 a month. So for a long time now, we've had a lot of couples use the excuse, well, we're not getting married because we can't afford it. The taxes are so high. So guess what, guys? Get your wallet out, dust it off, put some cash inside, because starting January 1 of 2018, unless you're making over $600,000 a year for your combined income, there isn't a marriage penalty. So you can't use that excuse quite any longer. So now that you have all that savings, you can use that additional Uncle Sam money that used to go to him if you're going to get married and put it toward a brand new sparkly diamond ring. Congratulations, now you can afford to get married. So, for example, now that you know, guys, you don't have to worry about that getting married, getting the ring on the finger, increasing your tax bill. You actually have some savings out there, and let's take a look what they are. So in this situation, your marriage penalty, if you're making $400,000 or less as a combined couple, you don't have anything to worry about because you'll have no marriage penalty whatsoever. But if you are making over 400, then guess what? There's not too many people are going to have too many sympathies for saying, I can't get married because I'm making over $400,000 and I can't afford it. That isn't going to work anymore. But under the tax bill that we're talking about, the marriage penalty predominantly has been eliminated. So let's look about the next area, things that you might be curious about if you do get married, because guess what? It means little kiddos might be on the way. Well, we have some good news on that as well. The child care tax credit that's available for children under the age of 17 has been doubled. The credit in the past was $1,000 and it's now $2,000 for each qualifying child. Now, it does something else that is very important. It increases the refundable portion of the child care credit up to a maximum of $1,400. Now, we still have some thresholds, however, in which your income is so high that this credit is going to be phased out. So if you were single in 2017 and you had children, your income threshold phase out was $110,000. Now it's $200,000. And if you're married filing joint, it went from $75,000 to $400,000. Now, the bill also adds something else which I think is important. If you have other qualifying dependents, such as a senior parent, you may now receive up to a $500 non-refundable credit for the care expenditures you're having in relation to that other qualifying dependent other than your child. But I also want to make sure you understand the amount of expenses that are qualifying expenses that the credit is calculated on has not changed. So for one qualifying child, it's $3,000, and for two or more qualifying children, it's $6,000. The credit is calculated as a percentage of the amount you spent, and it also involves calculation of your earned income. Somewhat a complex calculation, so make sure that you're looking to your tax advisor to assist you with this particular calculation. Now, capital gains taxes. The structure generally has not changed. The definition of a capital asset is still the same. Short-term capital gains are still taxed at ordinary income. The tax reform has revised the income thresholds for the various capital gain rates. The new capital gain thresholds do not match the previous income tax thresholds. So let's give you an example. In 2017, if you were in a 0 to a 15% marginal tax bracket, you didn't owe any capital gains tax whatsoever. If you went to a 25 to a 35% marginal tax bracket, you owed 15% on capital gains. And then if you hit the 39.6, then you hit the maximum capital gains tax at 20%. Those rates that were comparable to an income tax threshold have been eliminated. And now what we have is a long-term capital gain rate that's applicable to a level of income that you have that does not match up to tax brackets. So for example, now a single taxpayer can have up to $38,600 of income and they won't owe any capital gain tax at all. A married filing joint couple can have up to $77,200 and they don't owe any capital gain tax at all. So now generally you're going to be in the very much upper income tax brackets like you were before you hit the 20%. So capital gains hasn't changed much, just the way that we calculate the tax has. So in the tax bill, we've had some changes that are pretty significant when it comes to standard deduction and personal exemption. In the past, in 2017, each one of us had a personal exemption amount of $4,050. Now that means larger families, let's say you had 6 children, that was a very large exemption amount on your taxable income that you got to deduct. However, now in 2018, the personal exemption has been totally eliminated. In its place now, we have a new standard deduction that's on general basis about double what it was in the past. Singles previously had a standard deduction of $6,500. Now they have a standard deduction of $12,000. Married filing joints in the past previously had a standard deduction of $13,000 and now is $24,000. So this was meant to be a tax simplification. It will, however, impact families that are very large. It'll impact them more negatively in general than it would other people. So the next thing that was a change to the Tax Act is something that was an area that I was very pleased to see. It's a very misunderstood area of taxation. It's called alternative minimum tax. And most tax preparers refer to it as alt-min. And everybody goes, what in the world is alt-min? Well, alt-min was an alternative tax system that was imposed in 1969, and it modified the way that we actually calculated your tax bill. We calculated your tax bill first under your normal rules, and then we actually calced it again under the alternative minimum tax rules. Higher income folks under the alternative minimum tax actually got things phased out that were no longer deductible, things like personal exemptions, the deduction for state and local income tax, and certain miscellaneous income tax items. The biggest issue with alt-min is it had a threshold that did not go up with inflation. So since 1969, you can imagine wages are far higher. So the big issue was we had a lot of folks that we would not consider high income taxpayers becoming subject to alternative minimum tax. And especially those that lived in higher income tax states, they were screaming, what do you mean I don't get to deduct all my personal exemptions anymore and my state and local taxes? So the tax bill decided it needed to fix this problem because a lot of middle income folks were really paying more taxes than Congress intended when they wrote this provision. So the first thing they did in this is they indexed the AMT amount for inflation. So hopefully this bill will be able to assist people staying permanently out of alt-min taxes. But the other things that it did, it created new exemption amounts to begin with that are higher. So joint filers, for example, in 2017, the AMT exemption amount was $84,500. Now in 2018, it's $109,400. So we had all other taxpayers in the past, they were at $54,300 and now they're at $70,300. Now in 2018, the phase out, and what is the phase out? The phase out is when we actually started to lose a lot of the things like personal exemptions, which aren't going to apply in 2018 anyway, state and local income taxes, which for most folks are already limited, that I'll explain later, and miscellaneous itemized deductions, which in most cases are gone now anyway. The phase out doesn't start now for joint filers to $1 million. So really what we have is the overall impact of alt-min tax even though we've raised the limit, the impact on it is going to be less than it was in the past. This is an extremely complex area, and if you think you might be subject to alt-min tax, please seek professional help to assist you in understanding this, because this is an area that will remain complex. It always was and will still be in the future. Now, the next thing, and this is the one that has most people in our state really losing sleep over, and there's a lot of anger over it, and that is the new provision for state and local income taxes. Now, all state and local income taxes combined are going to be limited to a maximum of a $10,000 deduction under your itemized deductions. So what do SALT taxes include? Well, they definitely include your state income taxes. They include all your property taxes. They include things like your personal property. You know that portion of your DMV bills that were deductible? Well, that's going to be included within that $10,000 limit. And the one that's going to have some real impacts is going to be the personal property tax, or your real property taxes on your home. Now, in areas of California in particular, the San Francisco Bay Area, portions of LA, areas around the coast, where property values are outrageously high, and the median price of a home is already in excess of $1 million. The property tax bills on those already are going to be greater than $10,000 a year in many, many cases. So it means that state income taxes are going to be 100% non-deductible. Now, it's not just California that's going to be impacted negatively. California, along with good company, Connecticut, Massachusetts, New Jersey, and New York, those are the 5 states that are most likely going to be hit the worst. Now, the issues that we have going on here, however, is we have a lot of proposals to try to get around this. And I want to warn people that I think it's unlikely these proposals will be found to be legal. I'll give a good example. In September of 2018, California, for example, tried to propose a workaround for the non-deductible of income taxes for California. They actually had a bill, and they were thinking through this, that said we'd give you up to a $45,000 state income tax credit for every dollar that you contributed to designated charitable organizations that the state of California would take those receipts and use within their budget as they normally would, but they would reclassify the payment as a charitable deduction. Now, you can understand the IRS and Congress did not intend this to be a workaround that was going to be legal. Now, Governor Brown vetoed the bill. He vetoed the bill because he saw the likelihood of it being challenged successfully by both Congress and the IRS. So if you are reading articles about this, that there might be a workaround on this, on being able to deduct your state income taxes, I really offer caution. I think it's highly unlikely that these will stand, as far as the IRS is concerned, as being a legal alternative to deducting your state income taxes. Interest paid on a home mortgage may be claimed by an individual as an itemized deduction on Schedule A of their federal income tax return. That was the same as it was prior to the Tax Reform Act and still is true today. But the Tax Reform Act has changed the rules significantly regarding how much interest expense you can actually deduct. The first change is for mortgages incurred after December 15th of 2017. The aggregate amount of acquisition debt, which is any debt incurred to buy, construct, or substantially improve your home, cannot exceed $750,000. This limitation was decreased from the previous amount, which was $1 million in the former bill. Secondly, the home equity debt, which is any debt that is not acquisition debt, will generally not be an allowable deduction. However, there are a few exceptions that may apply, such as if the debt is used to build, buy, or substantially improve a home, and the debt was combined with acquisition debt, that does not exceed $750,000 limitation. For taxpayers who incurred their mortgage debt after December 15, 2017, the previous tax laws still apply. Most of them are grandfathered. The previous laws were mortgage interest was deductible as acquisition debt up to $1 million, and the mortgage interest debt was deductible on home equity debt if the debt did not exceed $100,000 or the fair market value of the residence, less any acquisition debt. So now that you've learned more about the home mortgage deduction, let's review it one more time. That was a lot of information to swallow, and we also have a little bit more detail we want to talk about. So the tax reform obviously is decreasing the allowable mortgage interest deduction. It was previous to this bill in 2017 and earlier that $1 million of mortgage interest, as long as it was qualified mortgage interest, you could deduct the interest on your income tax return via itemized deduction. Now that amount has been reduced to $750,000, but this rule applies only to mortgages that were taken out after December 16th, 2017. So you have an existing mortgage in place. Caution, caution. Are you going to be able to deduct that if you refinance it? Now, this is the area that we're going to have to wait for a lot of development from the IRS under the regulations. It appears that you might be able to, but at this point, it's not crystal clear. So if you're thinking about refinancing your house, please wait for clarification on these rules. Now, existing mortgages that you don't refinance that existed on December 14th, 2017, you're in a safe area. You can still write off the mortgage interest up to the $1 million limitation. But we have some new rules now on home equity loans. After 2017, home equity loans are not going to be deductible unless the proceeds were used to substantially improve your home, or were used as the definition of acquisition indebtedness. You purchased the house with it, but I want to make sure you get clarity. These rules are complex. So if you have a mixed home equity loan, you're going to have to very carefully trace through the details. What did you spend on acquisition indebtedness or substantial improvements to your home, and what was used for other purposes? Now, I also want to caution everyone, if you are building a home in the future and you intend to use your home equity loan as the down payment on the land and as the initial amount that you're using to build the loan, you need to talk to your tax professional and make sure you understand these complicated rules, because they're so difficult to even absorb on a tax professional basis on the first reading. The rules are complex. You have year limitations, which is 2 years to complete that home to be able to deduct the construction period interest. So I can't emphasize enough, again, this is where your tax professional needs to advise you to make sure that you're getting the maximum home interest deduction that you can and managing your affairs well in the process. A 529 plan is a program that's run either by a state or some sort of educational institution that allows you to put money away for a designated loved one in a tax advantage manner that lets you save in advance so that you can take money out later to help assist with their tuition. In the past, you couldn't spend money on a secondary or elementary school. Those were specifically excluded. Under the new Act now, you may. You can only spend up to $10,000 per year out of a 529, but you can pay now for things like private schools up to the $10,000 annual limit. Now, what has also been expanded on this is you now can pay as well as reasonable costs for housing and food programs that are on the campus or close to the campus. Now, reasonable hasn't been exactly determined yet, but most likely the cost of a dorm and a related food program is going to be the standard where the IRS will start to focus on what is reasonable and not excessive. We had confusion in the past if someone enrolled in an institution and then had to later actually quit before they finished their coursework because of illness or other reason. A lot of administrators of the various 529 plans didn't know what to do when the school gave a refund. If you get a refund back from your qualified institution, you have 60 days to deposit it back into the 529 plan, and it will be treated as a return of principal. Let's go over the rules for contributions. We now have a gift tax limit of $15,000 per person. So to put money into a 529, you have your annual gift tax limit. But under the 529 rules, you can fund 5 years forward. So I could actually put $75,000 into a 529 plan for a loved one all at once. And if I die, it will not be included in my estate as long as I live for 5 more years. Now, being married, my spouse and I could both put money in. Now, what's important to note is if you have a loved one who doesn't use all the money in a 529, you're allowed under the rules to move it. So I have 4 grandchildren. If I have one grandchild that's done with all their education, I may move the excess money tax-free into the other 3 grandchildren accounts. Any check that you write directly to the educational institution won't count against your annual $15,000 gift tax limit. So if your annual tuition is $30,000 and you're one single person and you want to help that loved one with their entire bill, as long as you write the check directly to the educational institution, you have not exceeded your annual gift tax limit for that loved one. Matter of fact, you haven't used up any of it yet, and you don't owe a gift tax return. So between the changes and improvements to the 529 plans under the Tax Reform Act and your ability to write checks directly to educational institutions, you can do significant things to help loved ones get through the college or other institution and training that they need for their future. So the tax bill gives us some wonderful opportunities for educational tax breaks. The Section 529 educational plans now provide for distributions up to $10,000 for tuition expenses incurred in secondary education and attendance of things like a private, public, or religious elementary or secondary school. We've never had this opportunity before in the past. So we have been able to use the funds in 529s in the past just for college, and now that has been expanded. Now, the rules applicable to this are somewhat complex. One of the things that we also now get to cover are homeschooling expenses. So homeschoolers have a lot of curriculum they have to buy. Those are qualified expenses. They also now include tutors. The tutor, however, cannot be related to you. Now, in the Technical Corrections Act, there may be an exception because one of the things that's been raised is, what if your grandmother is a teacher? Or what if your grandmother has a master's degree in child development? She is an ideal tutor and may actually be able to reach a child better than a stranger. We may get a Technical Corrections Act that would allow a relative to be that qualified tutor as long as they demonstrate that they have the credentialing necessary to be an effective tutor. Now, the other thing that's been also very helpful to 529 plans, we've had some real complications in the past that someone went into school, especially in college, because previously we couldn't use it for secondary education. They became ill or were injured and they had to withdraw from college. Well, the money that was sent to that institution is refunded back. And there was always this scratch of the head moment. What do we do with that? Is that going to be taxable income? Well, now this bill adds clarity that you may redeposit that money back into the 529 and it will be considered a return of principal and will not be counted in your annual gift tax limit or as an additional contribution. And it will remain tax-free in the process. These are wonderful developments in the 529 plan. Now, there are two other educational tax breaks I'm going to remind you exist, but they haven't changed, but I want to remind you they're out there. And that is the American Opportunity Credit. It's still a maximum credit for $2,500. And we also have the Lifetime Learning Credit. It hasn't changed. It's still there. And it's a maximum credit of $2,000. So between that and the deductibility of student loan interest, there's lots of ways to help a loved one get through college and make sure they have a better opportunity in the future. With the passage of the Jobs Act and tax cut, there are several changes to charitable contributions that you should be aware of. The first is a very important one if you itemize your deductions. In the past, if you were a substantial giver to your favorite charities, you could eliminate up to 50% of your taxable income through your charitable giving via itemized deductions. Now that limit has been increased to 60%. So if you are one of those phenomenal givers, now your deductions are greater than they were in the past. The laws have changed on documentation. We've always been required to have documentation in the past, but now you must have your written acknowledgement in hand from your favorite charity before you file your tax return. Otherwise, all that money that you gave away will not be deductible. So for all those people who like to give to their church, frequently with cash, make sure if you're going to give cash, you put it into an envelope with your name on it, because a church can't track cash without your name. So we've got a lot of other changes along with this that are going to be great as well. One of the things that we overlook are several options to give to our favorite charities or house of worship. The next one is the little old stock certificate. So give me that bag back. I want to give some more. So if you have an appreciated stock, make sure you think about that when you're in your favorite house of worship or other charity. If you have an appreciated stock that you've owned for about a year or longer, and again, it's appreciated, it hasn't lost value since you purchased it, you can actually give it to your favorite charity and take a deduction for its full value and not have to recognize the gain on the appreciated stock. And remember, your favorite charity, they usually don't have to take in the gain on the stock as well. They get it as is and sell it and not have to recognize any taxable gain. Now, the last area that we overlook a lot is the passage of a rule that was in place a couple years ago and now is extended. But it's an important one. So in tax planning, we really have to talk about this one. We have something called a required mandatory distribution if you're 70 and a half and you own an IRA. That required mandatory distribution can be directed directly to your favorite charity. Make sure the check is payable to the charity and not yourself. Now here's the trick. If you give your IRA required mandatory distribution to a charity, you don't have to take the IRA distribution that you gave to the charity into your taxable income. And here's the huge benefit. With the Tax Act that just passed, our standard deduction has increased substantially. So if you don't have enough itemized deductions now to actually itemize and you take the standard instead, you can still enjoy the tax benefits of giving to your charity because you won't have to take that RMD into your taxable income. So with all situations, always make sure when you get that bag that you ask and you document. When you give money, you get that receipt. Our favorite charities are counting on you. You can be more generous than ever and enjoy the benefits of being able to have a tax deduction or a tax cut. So, a lot of good news in the charitable deductions area, but I do want to go over, however, 3 changes to make sure that's clear in your mind. The first one, that one I mentioned, we actually now can give more of our income away. In the past, we could give charitable deductions and it would offset up to 50% of our taxable income. Now remember, charitable deductions go into itemized deductions and then the offset for other things occur. But the net result is we got a deduction up to 50% against our other taxable income. That has been raised to 60%. Now, the other thing, however, you need to be aware of, if you're a great deal sports fan and it's super important for you to go see your live football game or other sporting event, and you do this by buying season tickets, in the past, many schools had season tickets that had a stated price on the ticket, but if you wanted seats that were reserved for you, you actually had to make an additional contribution to that institution to be able to have the privilege of having season tickets. That additional contribution to your alma mater or whatever other institution you made to get those season tickets, that deduction's gone. So you still get to enjoy your sporting event, you just won't be able to get any income tax benefit from the purchase of them any longer. Now, the other thing I really want to point out is we've had some rules on substantiation changes. It's very important you realize you've got to have a documented receipt before you file your tax return to be able to take your charitable deductions. No receipt, no deductibility. Obamacare. Yes, there's been changes made to Obamacare, but not as many as people think. I've had a lot of people calling saying, oh, Obamacare was repealed. No, it was not. The Obamacare penalty are going away starting in 2019. So if you don't buy Obamacare health insurance or you have no health insurance starting January 1, 2019, you will no longer be subject to the penalty. So the penalty in the past was $695 per person, or whichever is greater, 2.5% of household income was your penalty if you didn't have health insurance. So starting January 1, 2019, that penalty goes away. But for 2018, the penalty is still there. So if you don't go out and get health insurance from whatever source you are able or want to, you will still be subject to the Obamacare penalty. Now, one of the things too that also did not change is when we adopted Obamacare, we created what was a tax called a net investment income tax. That was 3.8% of investment income. That additional tax was not repealed under this bill. It's still in place. And they kept it there because it was a balancing act. They needed to keep this tax bill more budget neutral. Now, the other thing that I want you to realize is the Obamacare penalty going away has some hidden tax benefits. One of the things under the Obamacare bill, and in particular in California, that was not an intended consequence of passing this bill is many people were forced onto the Medi-Cal system that shouldn't have been there. So I'll give you an example. When being able to apply out to the Obamacare website, if you have income that's below certain thresholds, you actually get forced on to the California Medicare system. Now, this doesn't mean you can't afford your own health insurance plan. So for example, I've actually had situations where clients were worth millions. And because for some odd events on their income tax return, they had very low taxable income. And they did not want to get health insurance because they felt they were wealthy enough that they were self-insured. Well, they were forced to get onto Medicaid to avoid the penalties, which they wanted to do, or Medi-Cal, and they didn't want to be on that system at all. But suddenly the state of California was paying their health insurance premium. So getting rid of the penalty will mean those who are wealthy enough to be self-insured and don't want to buy it no longer are forced to buy it and forced us onto the California Medi-Cal system. So there will be some hidden savings there under this bill. So the new inflation. Did you know that when inflation goes up, you change your buying habits? So the IRS thinks that now, or they're going to tell you that's what you're going to be doing. Congress obviously believes this is true. So we have a new inflation calculator that is going to be used against all of the increasing tax brackets in the future and anything that's tied to a CPI chain. Now, this new inflationary policy they're putting in place is called basically it's a replacement theory. So, for example, if you've been enjoying steak and steak goes up significantly, it says you're not going to buy steak anymore. You're going to go buy chicken. And if chicken goes up and steak goes up, you're going to go buy fish. Now, this isn't really how people operate. So I'll give you some examples. If gasoline goes up, do you go out and buy an all-electric car because gasoline went up? But these are some of the understandings now the IRS is assuming that you're going to operate under, and they're changing the way CPI is calculated. It's called Chain Consumer Price Index. It is a way of reducing the inflationary effects on tax brackets. So basically this means you will pay more tax in periods of high inflation versus ones that where inflation is more mild. This is just another example is, well, we give you in a tax bill, we slightly take back away. Under the tax bill, estate tax exemption amounts have doubled. So in the past, if you were a single individual, you could have an estate worth up to $5.6 million and you would not have to file nor owe any estate tax. That number has now doubled to $11.2 million. Which means a married couple now can have up to $22.4 million in assets, and they will not have to file a 706, nor will they owe any estate tax whatsoever. Now, please understand, if you have made gifts in the past that exceed your gift tax limits, those gifts still have to be added in to arrive at your total taxable potential estate. Now, anything exceeds this limit, we still have the estate tax of 40%. So the gift and estate tax tables are unified now. So if you give something away, you don't have to worry about a gift tax return not matching the exemption limit on a 706 return. This is an area somewhat complex. If it affects you, again, this is an area. Seek tax advice, professional tax advice. This is complex. But this is new increase in the estate tax exemption is essentially going to eliminate about 90% of all 706 filers in the future. So this is the area of the tax bill that is the one that's probably long awaited by many of you in the room if you are a business owner. The Jobs Tax Cuts and Jobs Act, as it's known, I've kind of rephrased for the Business Income Tax Reform as the Tax Complication and Jobs for Accountants Act. Because I'll tell you what, the Business Income Tax Reform is the most convoluted, complicated piece of legislation I have ever seen in my lifetime. It is going to be difficult to calculate, and in many cases, you're not going to be able to calculate it by yourself. You're going to need the aid and information from other related entities that other tax preparers may be preparing on your behalf. So let's just generally go through this. Now, before I get into all the details, there are some simple business income tax reforms that are also important. For example, we have some new bonus depreciation rules. So for qualified property that you're putting into place, in the past, we could write up to 50% of it off. That has now been increased to 100%. And the beloved 179 deduction, it was limited to $500,000 of assets, a maximum amount that you could write off in 1 year. That's now been increased to $1 million. The phase out of it now for assets placed in service has been raised to $2.5 million. So the overwhelming vast majority of people are going to be able to write more off under 179. Now, in relation to that, however, with the 179 deduction, as it relates to now this new 199A, is also going to be a complicating factor. Because if you write off too much, you might actually lose an income tax deduction. So some of the things, though, before I get into that, we also have some changes on luxury automobiles. In the past, we had limits on luxury automobiles that were so ridiculous, you could go out to a new car lot and find one of the most economical cars on the lot, and under the old tax bills, it was still considered a luxury automobile. Well, fortunately, after December 31st of 2017, those rules have been substantially changed, and we are allowed a greater depreciation deduction than we were in the past. And we basically have luxury automobiles now are those vehicles that are priced in excess of $50,000, a more reasonable price tag. Anything over 50, we still have some luxury rules applied to it. Now again, deducting automobiles and bonus depreciation and 179 is going to impact what is now known as your new Section 199A deduction. This new deduction allows sole proprietorships, sub-S corporations, and partnerships to deduct up to 20% of the income they earn from the business. Now, the deduction is limited to the greater of 20% of qualified business income, or 20% of taxable income less capital gains. Yes, and if you think this sounds complex, we're only beginning. Now, there's some phase-out rules on this. The phase-out rules are basically over a little about $157,500 for an individual and $315,000 for a couple. But if you exceed that, then there's additional limitations on how you calculate this. It is then limited to the greater of 50% of the W-2 wages from the qualified trade or business, or the sum of 25% of the wages of the qualified trade or business plus 2.5% of the qualifying tangible depreciable property. Now, is this simple and straightforward now? I'm so glad you think so, because now we have another set of rules on top of this. Now, each business line is going to be calculated separately. So if you have a corporation that has multiple business lines in it, or a business, you're now going to have to account for each one differently. You're going to have, for example, if you have a hat maker mixed in with someone who's manufacturing fabric, the hat maker is going to have to be separated from the fabric to be able to calculate this deduction correctly. Now, I'm not going to go into all the detail because this area is easily the most complex tax provision I have seen written in the tax code in over 40 years. Yes, over 40 years. Now, to understand this also, I want you to realize there are certain areas of service business that are not going to be allowed to take this deduction unless they have income below thresholds. And those are service-oriented businesses. This is going to be things like lawyers, accountants, financial services. But the code also, however, is calling service business organizations as one that must limit their deduction. The code section in the past delineated what a service business was, but it's not clear that this bill actually meant to use that code section, because it actually exempted certain people under the code section that were considered service business and said, oh, these aren't. But it's dead silent on other areas. So, example, if you are a barber, a beautician, you do nails, if you are a photographer and you're providing a service, it's possible that you are going to be incorporated into these service business rules. This is a complete unknown, and I want to emphasize the Section 199A deduction must have more clarity from Congress. We're hoping we will know what that clarity is by the end of the year, but right now it believes because of other issues being distracting Congress, it appears they're not even going to discuss clarification of some of the technical corrections under this bill until the first quarter of 2019, which means a great number of people who are business owners are most likely going to have to file an extension. But if you are a business owner right now, these rules are so complex, I really suggest strongly that you contact your tax professional now before 2018 is over, because you may be able to increase your deductions by making minor adjustments in how much wages you take out of your business versus what you retain inside your business. It's very important to realize these rules are enormously complex and can have unintended consequences by actually doing things that you think are normal and good tax saving tactics in the past. So again, this portion of it, again, is the Tax Complication and Jobs for Accountants Act. Just remember that, because your accountant is going to be very, very busy and you need to make an appointment now. Now, what I've done to try to simplify this, I've put a chart together. If you would like this chart, it helps summarize in a flow chart everything related to the 199 deduction. If you'd like this, please contact us and we'll gladly send it to you. Now, the last section that we have of the tax bill is the corporate income tax reform. Now, this is a very important part for our large corporations in the United States. The Corporate Act reduces tax rates right now in the past that were in 2017 and prior, a maximum of 35% down to a maximum of 21%. It is a 14% reduction in the income tax bill. It also repeals alternative minimum tax for corporations starting in 2018 and onward. It also changes significantly net operating loss rules. And these rules, again, are complex and they apply to both corporations and individuals. So I want you to realize if you have a net operating loss carry forward, or if you're anticipating to have a net operating loss in 2018 or beyond, please contact your tax professional, because the rules are so significant now, they require much more careful planning than they did in the past so that you can optimize your deductions in this area. I want to emphasize, if you have high levels of capital gain in 2018 and beyond and a very large net operating loss on your from your business, that loss from your business will no longer dollar for dollar necessarily offset that capital gain. So this is a very important area to get tax advice on. Now, the new internal tax system is also changed for corporations. In the past, we had a worldwide tax system. Wherever the money was earned, if it was a U.S. corporation, it was subject to U.S. income taxes. The new system, however, is subject to pay income tax only on U.S. earned income. And the new territorial system says if you have a branch office outside the country, that income is not subject to U.S. tax. Now, to give you an idea where we're going, with the new tax rate of 21%, the average tax rate worldwide is about 25%. So this gives us a very competitive advantage. However, under this tax bill, there are some mandatory deemed repatriation of income taxes. The tax, or the act, requires that any earnings and profits undistributed from a corporation that were previous to post 1986 must be paid the tax. And the rate applies differently in whether the earnings and profits are held in liquid assets or non-liquid assets. So if it's a liquid asset, you owe 15.5% of that money to the IRS. If it's a non-liquid asset like equipment, it's going to be 8%. Now, to give you an idea of how different this is, here's the 2017 corporate tax rate. You can see you can quickly get up to the 35%. Now it's a maximum of 21%. But to give you an idea also of how much income tax in the past was not being collected, at the end of 2016, just 322 Fortune 500 companies collectively held $2.6 trillion offshore and avoiding $767 billion in U.S. income taxes. So this change to the corporate tax code will make them more competitive worldwide. It makes them more fair, so they only tax on UN taxes. But what it'll also do was it will actually encourage U.S. companies not to offshore everything and increase corporate income taxes overall. Now with that, I want to just once again add, there are so many areas of this tax bill that need clarity. This bill was put together in a great rush. It has many errors contained within its provisions. And in this presentation, we are presenting the law as it is understood at this moment. We anticipate significant changes when we actually have modifications to correct obvious errors. So make sure that you check with your tax professional and don't assume that what we presented today will be the absolute final version. We're anticipating many changes ahead. So thank you so very much. If you have any questions, please do not hesitate to email us or call us.